What if publicly traded companies cease to exist?
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks, everybody, for listening and watching.
Great to be here as well. So, a few episodes ago, we were talking about real estate, and we'll probably have another conversation down the road because we still couldn't come to any kind of final conclusion. I think we're going to continually disagree on that. But I'll say realization, not quite conclusion, but realization that Trishul brought up was real estate as a store of value versus a driver of economic growth. Like, where do returns come from?
Mm-hmm.
And I made this kind of comment, like, what if AI kills public companies? As is semi throwaway comment, and Trishul was kind of stunned. And today, it's been a few months, so that comment's been still sticking with both of us. So part of my premise might be too strong, but the lead up to that was publicly traded stocks and publicly traded companies come because they need capital. They have built something, they want to make it bigger, they need capital they need money to hire usually more stuff, more employees, more office space, more infrastructure, depending on the type of company. Could be like building a warehouse, could be building a factory, could just be hiring more engineers, depending on the type of company. And with AI, if we think that it can get to a place a generation from now where it's replacing a lot of those workers, and so you build something and then you can use an AI agent to kind of do a lot of the engineering work, and you don't need the office space, and you keep building out multiple AI agents, you might be able to build and scale a very large company without needing outside capital.
Mm-hmm.
And so today we're going to kind of talk about a little bit how publicly traded stocks and publicly traded companies work, what the capital structure is, but then also try and think of what if we don't need publicly traded stocks. So Trishul, I'm going to let you start. Kind of give us your primer on why companies raise capital and become publicly traded stocks. So you and I own a business. Mm-hmm. We are not looking for shareholders in our business.
Mm-hmm.
Okay. But describe that difference of scale of for-profit businesses that are looking to raise capital to build up and grow larger.
Right. And you can imagine there's been an evolution of this notion over the centuries. So before you had stock exchanges, right? You had companies for sure, and you had owners of those companies, and you had to have some way of first defining who's the owner, right? Who owns who are the owners, and how do those ownership interests get transferred, right? So let's start with private companies first. And essentially you have these entities where within each entity you have some sort of ownership right? And this ownership right could be with some sort of private stock, basically pieces of paper saying, here's who owns what. Or it can be contractual, however it happens to be.
Okay, so maybe before the Industrial Revolution, someone owned a farm that was making enough crop they could sell the crop to a city, and they had a profit from that farm.
Yeah.
And when that person passed away, they had children. It would pass to those children, but they could divide up the farm to each of the individuals if they wanted. You could divide up the land.
Yeah.
That's an example of a pre-Industrial Revolution, pre-stock certificate kind of transfer of ownership.
Yeah, like, frankly, the majority of it back then, as you alluded to, was just land, right? You
Yeah.
have titles, and
Yes.
the titles of land are literally just recorded in a book in the municipality. And when ownership changes, well, then a line is updated basically
Yes.
in the book saying, here's the new owner. And essentially that's how you can track the lineage, I guess, of companies. You look in older pages of the book.
Yeah. Yeah.
And that tells you how things got passed down. But when you have companies that are beyond just land, then you need just some other recording mechanism.
Mhm.
But these are handled probably like by contracts and things like that. For example, if you actually have a business doing business type things like selling widgets, right?
Mhm.
It may be the widget factory that represents the ownership and the percentage of that factory. But then, as the system began to evolve, you have more things than just building. You have intellectual property, right? And you have, in the technology age, a lot of assets that are not really hard assets. They're soft assets like
Mhm.
software. And you still need the ability to define ownership, and you need the ability to also raise money. So with private companies, the way you raise money is you go to a bank and you say, hey, here's my company. Here's how good we've been doing. You have some financial statements to back that up. And then the bank says, all right, let's underwrite a loan, right? Let's
Mhm.
lend you some monies. And that loan goes on your books as debt.
Mhm.
And basically the valuation of the company, it can be looked at as the amount that's controlling debt, right? The book value of the debt, and the amount that somebody might pay for actually buying out the equity interest, holding the papers of the ownership of the company. So
This is the classic assets minus liabilities equals net equity.
yeah. So the assets would be the fixed assets like the land,
The land, the warehouse, the
the
factory.
factory, right? The inventory, the intellectual property of like the software, goodwill, things like that. Like a big asset for Coca-Cola is the brand name
Mhm.
Coca-Cola,
Yeah.
right? It's this soft item, but it's worth literally tens of billions of
Yeah.
dollars, right? The name, the brand itself. So this all goes into the assets, and then Coca-Cola company has a bunch of debt, and if you take the assets minus the debt, you get the actual valuation from an equity standpoint.
Mhm.
And then you split up that equity amongst all the shareholders, to figure out who owns what. Okay, so now before the public exchanges, the only way to sell these shares is you gotta convince other people this is the value, and they could buy interest in or sell, or take over some of your interests or in this private entity. And I guess the purpose of the exchange is to come up with some sort of mechanism or marketplace to sell these interests in these companies and try to standardize it. So that's kind of how this all began. What's a way to come up with a place where people could meet and exchange stock? So the first one was actually in the 1600s, using the Dutch East India
Mhm.
Company as its model. This was like probably one of the largest corporations probably ever, right? The trade business between Europe and Asia, right, created this model where you needed tons of upfront capital to buy these boats.
Mhm.
All the boats would come back, right? But they would sail over, bring back money, or sorry, bring back spices in exchange for money, and then you just rinse, cycle, repeat.
That's a great example of you need the upfront capital to build the ships, hire the sailors.
Yeah.
Like you get no profits for a year, or I don't know how long. Like year and a half, 2
years.
years. Yeah,
Yeah.
like to sail out and sail back.
Right.
And so instead of one person putting all their money at risk on this one boat with all the sailors, they found it's
Yeah.
easier to divide that up among 10 to 100 people or even more.
Hmm.
Of everyone's going to put the money in, and therefore we'll all split the profits evenly as the
Yeah.
owners.
And not everybody can just finance a whole boat, right?
Correct.
So, but it became understood that we need a lot more boats,
Mhm.
right? But there's just not enough people to buy whole boats.
Mhm.
So the notion is, let's create an exchange where everybody can, meet together in a marketplace, understand the principles of the exchange and what percentage of the boat you might own, et cetera, and start financing boats that way. So that capital gets raised, more boats get purchased, and more trade happens, and it just leads to this kind of virtual cycle of increased productivity, increased gains, increased wealth, etc. So, this model probably stood until like the Industrial Revolution, I'd say, where now we have a lot of new types of expansion, right? You have like railroads, you have banking institutions set up all over the place, you have these big expansion projects, and you have factories showing up, right? And all of these different things. So, just more need for capital and more ability for individuals to participate, because you start having something like instead of the richest kings owning everything, you have more individuals with actual monies and the ability to go out and build things and whatnot.
So you're talking like, you get the same idea. We need to build a railroad track. We need to hire people and the materials that up front before the railroad generates any profit. If we're going to build a skyscraper, we need, again, lots of materials and people to build it. Need a lot of that upfront capital. But once we either sell the building or rent it out, that's how we'll start making money off of it. And then everything that feeds into those systems of, okay, who makes the actual railroad track, because they don't make them out. It's like, okay, we got to get these railroad tracks and now transport them. Okay, who is making the girders and the concrete for the skyscrapers? And so you start getting like this entire economy around being able to build and grow, but again, a lot of it required that upfront capital before there's any profits.
Yeah. And, you can imagine way back, like 1600s, the only powers that could finance these big initiatives were the kings, right? They owned all the land, and they had all the monies, which they raised from like taxes and whatnot. But as the ability to make money off other things besides just land increased, like the different opportunity sets that started to arise started to multiply, then there became more of an ability to grow and create wealth, but also more of a desire to raise money, right? Just more of a need for capital expansion.
That's a good point, is that pre 1600, one sovereignty was funding everything.
Yeah.
Starting in the 1600s moving forward, we now had a structure in place where multiple entities or people could fund one big project.
Yeah. And, the purpose of public markets is just to standardize this exchange of ownership, right? To come up with a place where people could exchange ownership, but also understand what's a good fair price, meaning here's what this ownership has been worth in the past. Here's what's impacting its price. Here's information all coming into this exchange, like news and all that. Like, this company lost 5 ships and this one only lost 1. Therefore, this one who lost 1 is doing a better job at not losing ships. Therefore, I'm going to pay more for, this one person rather than this other captain who can't get his act together.
You also get, if I made an investment in a ship or a railroad that doesn't pay off for years, and something else happens in my life, I need to sell my ownership percentage.
Right.
And again, like creating that standardized market, it's a lot easier to find someone else to buy that. Even if like there's no news, it creates liquidity for each individual owner to be able to kind of cash in their shares. Like it, and it might be worth more because if it's a 3-year project and I've already gone a year and a half with no profits coming in, the next person might be able to pay a little bit more than I did because they only have to wait a year and a half instead of waiting 3 years.
Right.
So now, like I have, with no change in news, just I have made money on my stock, even though no future profits came in yet.
Yeah. And you can imagine, for example, how challenging things were before currency, right? Everybody had to barter for things and exchange goods. And then they said, let's standardize it to cows or whatever, and then let's create currency. Well, similarly here, it helps to have a marketplace where people can come together and understand what a fair price is for now instead of goods for actual companies, for the ownership right to the equity interests of the future cash flows of an entity.
You start to get into like bank notes are were like literally notes of I have enough gold to buy this thing, instead of me going get all the gold from the bank, hand it to you to build the ship. Okay. And you have to take all the gold and go back to the same bank because there's only a few banks in town that are going to like hold the gold for you. They'll write a note say, hey, this person has this much gold in their accounts. They'll hand the note over, and the other person just take that note back to the bank, like, and they'll transfer record of ownership of that gold to the next person who for selling the ship. So you start to get into this kind of paper tracking level of economy, and stock certificates would work very similarly, where you don't have to like write your name on the boat kind of thing. You now have a record of I own how this many shares in this particular company or stock. So we start getting into more paper economy where there's now handwritten tracking of ownership, of both ownership of gold. That's what the start of what we think of as currencies was some kind of bank note showing, hey, we held this amount. Eventually is taken over by governments funding these. And that's why I think what the gold standard was for a long time. But same idea with stock certificates of we can exchange paper records of we made a transaction, and we can report that to the bank or a government or the like municipality, or like I said, like the stock exchange.
Right. Yeah. So I guess this kind of brings us to like the early 1900s, where you had like the early exchanges in the US. And I guess you can define it against like pre-Great Depression, post-Great Depression, right? So like before, it's basically the Wild West. You have all of these different types of get-rich-quick stock type scams.
There were a lot more railroad stocks being sold than actual railroads being built.
Right, yeah.
Because again, they saw like the really rich people, like, oh, they own railroads. I want to get in on that railroad stuff. Like, I'll sell you a piece of paper that says we're building a railroad. And that was the creation of the SEC and a lot of the fraud protections for stocks.
Yeah. So basically, you can think about the Great Depression as being a big bubble in the public markets for stock, essentially, where you had way too much speculation, lots of novice investors probably just throwing money at it. You probably had a large demographic of individuals who had money to put to such use for the first time. This is early industrial revolution. So you have
more
just
incomes than barter.
Yes, right. So basically, the middle class is just getting off the ground, I'd say, kind of, right? You're just kind of building up to the point where you have the ability to think past this year in terms of savings, right?
Yep.
Disposable income from that perspective. And yeah, it just led to a crazy run up with these stocks, crazy valuations, and things came crashing down with the Great Depression, which led to the SEC Act that Aaron you mentioned.
I think the other part of that's interesting. The Great Depression I definitely associate with like railroad stock fraud and the creation of the SEC.
Mm-hmm.
And but I also think like Industrial Revolution part, like and there might be a little bit of like Great Depression, 30s, World War II, like transition,
Mm-hmm.
but there's also, like you said, we have a lot more factories being built
Yeah.
over from like the 1870s to the 1920s or so.
Mm-hmm.
You have a lot of these capital intensive projects as we're literally building more things. So we need
Yeah.
both like money for raw materials, money for employees, money for factories before we can turn any kind of profit. But we now have the technology and, like you said, intellectual property to be able to do some of these things.
Yeah. So what the piece that was kind of missing was this regulatory component
Yeah,
where you didn't quite really know what you were getting, and there could be pretty much any claims being made by the people selling these that
yeah,
weren't really backed by actual, like you said, even actual businesses. Even it was just probably just fraud, just lots of
yeah.
fraud
It's
all
just
over.
a lot of straight up fraud.
Yeah, that's probably the easiest way to put it. So the Securities and Exchange Commission laws were designed to increase disclosure, right? Saying, hey, this is what this is all about. Increase some sense of like audits,
Mhm.
right? Like these financials mean what they say because they've been signed off on. And also provide some protection for investors. So the goal is to kind of shore up this exchange so people actually have confidence in it,
Yeah,
so that they're more willing to actually put their money to work, and also they have more confidence that it's going to work for them rather than just being defrauded.
yeah,
So this led to basically a huge growth in the public markets, and they became pretty much the primary model for raising capital for the next like 70 years or so.
yeah. We're seeing again the industrial revolution, the advancing technology. Like think of just cars and planes. Like
Yeah.
just building like the technology it takes to build the first few cars.
Hmm.
And like again, if you can build a car, the intellectual property in that car is still very, very valuable. But to build 1,000 cars, again, you need that again, raw materials, employees, factories. Like this is a really good, simple example. And we start to get into what we think of in terms of modern economies. Like, okay, now 2, 3 years later, we've built a better car, and we start to like be able to create this like larger, wider economy of if you have the excess income, you might want to buy the newer technology versus those who are at a middle class might be content holding on to their older technology. And like that kind of widening of like technological advancements and goods and services spread pretty well. So that's why we kind of going through World War II, our technology was starting to get really, really high, and we've actually started to build a really big middle class.
Yeah. Yeah. Like the success story of the United States is basically after Europe was kind of decimated after World War II, you had US industrial factories that were still standing and took
Yes.
up all of the demand for the planet and created a very strong middle class for the United States. And
Starting
now,
this really fortuitous cycle of
yeah,
like incomes in the US were increasing in the 50s, therefore demand was increasing, which meant more like more advancements in technology, more like selling goods. Like we start to see this economic growth cycle coming out of the 50s, uh, that was the beginning of probably creating the U.S. as a like consumer economy.
Yeah. So by the time you're into the 70s, you have like 401ks all over the place. You have index funds allowing people to invest cheaply. You have IPOs just all over the place because all this innovation with technology
Yeah.
could be funded with a $50-100 million IPO spread across our entire population. Why not, right?
So I think I do want to push back. Like, while they technically existed, I don't think there's much adoption. Like, I'm curious when is it Jim Bogle, the founder of Vanguard?
Jack
Bogle. So close. I'm sure one of those is his nickname. When he created Vanguard, I think it might have been 70s or 80s, but that was still really rare. This was an era of stockbrokers. Like,
Sure.
okay, I'm going to help you invest your money in stocks across a variety of different stocks, and I'll help you try to choose better companies to invest in and worse companies to invest in. So that was much more common in the 70s and 80s than an index fund or trying to like even the mutual funds started in the like late 80s, early 90s, getting more adoption. The ability to the regulations for a mutual fund existed going back to 1940 with the Investment Advisors Act, but we're now seeing like there wasn't much adoption. There's still people wanting to choose stocks, but we're starting to get research like modern portfolio theory from Harry Markowitz came out, I think, in the 60s. And so we're starting to see, okay, people are understanding, yes, stocks can be a great way to make money, but diversification does matter.
Yeah.
And so it's kind of hard for any individual person to spend, like, I work in a factory, I don't have time to go research the few hundred stocks that are available to me. So the profession of a stockbroker started to come into play, where now there will be someone who will help you choose the stocks to buy, and they'll do it for a small commission on each trade.
Yeah. So you had the larger players initially, like the pensions, the endowments, the foundations, right? They all had the monies, but they still needed to figure out what to buy as well. So that they would have professional managers who used to figure out which stocks to buy, or they would outsource that. And then you had also individual investors who, like you said, that initially they might just call up a broker, but that the mutual fund's job was to say, hey, pay me some money and I'll figure out what stocks to buy, right?
Yeah.
And I'll package it in a product. And then you can select from my assortment of mutual funds and you can make money that way instead of figuring out which stocks on your own. You just got to figure out which mutual funds.
Yeah, so look at Charles Schwab founded his company in 1971. Jack Bogle. It was John Jack.
Oh, John
Bogle.
Jack. Okay, yeah.
Jack's
he goes by both.
John C. Bogle. Okay.
That's right.
Sorry, I got distracted. He founded Vanguard in 1974, 1975.
Yeah, with the first index fund.
Yeah.
So, and it took some time, of course, for index funds to take off. But the notion there is, instead of paying a professional manager to figure out which subset of stocks to buy, why not just buy them all?
I agree. There was still, again, actively managed mutual funds still dominate at this era.
Yeah.
They have so much more in terms of money going in because people like the idea of buying a mutual fund manager of, hey, I can do better than the index. I'm a professional. This is my job. I can do better than the index.
Yeah, so now we have decades of data showing that pretty much the indices do better. And so
I believe we have decades of data saying indices do better after fees.
Yes, of course. And that's what matters, because you got to pay fees for these mutual funds and the index funds, but the fees for the index funds are much lower. So on an after fee basis, index funds do better in the vast majority of cases. So, but what that meant, though, is now people could basically buy tons of different stocks for a very little amount of overhead. and a little amount of actual decisions. You just buy the index, right? And you get exposure to the entire market, essentially.
I think the other thing I do want to add in here is we talked at the very beginning how if you had a business and you wanted to grow, you would go to a bank and borrow money from the bank. You'd have a loan from the bank. We also started to get into publicly traded bonds, which function the same way as the bank loan. This is a company borrowing money, but it's now a structure where it doesn't have to be with just one bank. You can actually borrow from other investors who prefer the certainty of the interest on the bond over the speculation of the equity. But this is another form of raising capital, can come from borrowing, but it's just a different layer of risk. Basically, if the company does not do well, bondholders have to get paid out first. And so in exchange for that kind of higher level on the corporate structure, there's less return, so it's an interest rate. But if the company does well, bondholders don't get any extra. They only get the interest that they had negotiated on the bond, whereas the stockholders get all the upside.
Yeah.
But publicly traded bonds are starting to come into play. Throughout the entire same spectrum as stocks.
Yeah. Back to your very early formula where you had equity equal to the assets minus the bonds or the liabilities, right? Another way to rejigger that is the assets equal the equity plus the debt.
Yep. That's actually what shows up on a profit or a balance sheet. It's actually like your assets equaling liabilities plus equity.
Right. So basically the assets are what the business is, essentially, all the value of the business. And the value of the business is supported by these two things, the equity and the bonds. And if you add the two together, you get the price of all the assets. And what we're basically saying is that the bonds make up some component. Let's say the business is worth, let's use round numbers, $100 million, right?
Okay.
And 80 million of that is bonds and 20 million is equity. What that means is basically you have 80 million in debt and you got to pay interest on that if you're a holder. And then Aaron, as you just said, the 20 million of the equity, they don't necessarily have to get paid interest. They could get paid a dividend. But essentially, once all the expenses are paid for and once all the bond payment interest is paid out to the bond holders, then whatever's left goes to the equity holders, the people who basically are the actual owners of the company.
It's when a company has profits, at like revenue minus expense, all the expenses is your profits. Profits go to the owners of the business. In this case, the shareholders.
Yeah,
they can
interest.
choose. Yeah, they can choose. They reinvest the profits, like that's a corporate decision. Like, hey, we're going to try and build even bigger, or they can distribute the profits to the owners via a dividend.
Yeah. And that equity ownership, as we mentioned, is what gets traded on the public exchange for these companies and shares, essentially. So that $20 million basically could be sold on an exchange where if you have $10 a share, that would be 2 million shares, right? Traded on the exchange. So basically
This is actually a good thing, because understanding the dividends and the relation to share value is probably important, because it's not until we get to like the late 90s and tech era where valuation started to be a difference. So if I have a share that's worth $10 and it's issuing 20 cent, no, so let's say a 5-cent dividend. Is that 5%? Yeah. 50 cent dividend.
50.
There you go, 50-cent dividend. So this is the actual, like, a 5% dividend from this $10 share. And the company's doing well. And so, like, hey, they have more profits. They can now do a 60-cent dividend. And it's like, okay, I go to the market. Would I rather buy the stock that had a 60-cent dividend or the 50-cent dividend. That's an easy choice. I'll buy the stock that has the 60-cent dividend. They're both $10.
Mhm.
Now, what if I was have to do 6% is what 5% um, of 12? Yeah, there you go. So would you rather buy a $10 stock with a 50-cent dividend or a $12 stock at a 60-cent dividend? Okay,
Yeah.
now those should be the same valuation, both with 5% dividend. So it's the company making more money, increasing their dividend meant the value of the stock went up. That's why the stock went from $10 to $12. And so if I hold that first one, I now have a choice. Do I keep collecting the 60-cent dividend at 5%, or I can sell what I bought at $10 that is now worth $12 and I can get a $2 gain. I
Mhm.
can make that choice at any time. And this dividend and ownership was a big driver in stock prices for decades. That there's like a very easy thing to see. If this company has more profits, they literally pay out more profits via dividends. That's what drives the value of that stock up. Because
Mhm.
we did see very consistent dividend yields, the percentages. We start to get into kind of risk-free interest rate conversation. So interest rate environment matters. If we get to the 70s and treasuries are like 7%. Okay, but this stock is at 10% dividend. Okay, that's kind of like our comparison across stocks. And so if there's another stock that was instead of a $10 dividend on a $200 stock price, there's another one that has a $12 dividend that tends to push that $200 stock price up to 240.
Yeah.
So like the actual dividend was increasing the stock price. So like this is a very clear signal. This company is more profitable. That's why the stock price went up.
Yeah.
The-
I was just going to tag on. So essentially, what you can think of as the price of a stock is you take up all the value of the future dividends and
yes.
you add it up together, and you got to discount the values that are so far out that it's going to take some time for you to get them. But if you do discount all the future values of the dividends appropriately and you add it all up, you should get the price of the stock.
Yes. That discounting rate is usually inflation or treasuries or some other kind of like risk-free interest rate. So,
Excuse me.
so this goes until we start to get into the tech boom of the 90s, where that same theory of the future revenue from this company and the future profits should inform today's stock price. So even though Apple isn't issuing a dividend ever, like it literally like didn't issue a dividend for the first 30 or 40 years,
Yeah.
the revenues and the profits of the company showed, hey, eventually it'll be extra profitable. And so we started seeing in the 90s, stock price itself could go up based on the projection of those future profits, even if they weren't actually distributing any profits. And
Yeah.
so now we started to get into this different dynamic of the stock price, instead of issuing that 5% dividend, if all the profits inside were the same, the stock price could go up by 5%. And so you don't have to take the profits if you don't want it. You can leave it invested and the stock went up 5%. You could choose to sell the stock. You got your 5% return and it's like same exact thing. Or you could hold on to it to see if that 5% return could repeat the next year. But we started to look at because these were going back to the SEC rules, because they have to disclose what their internal financials are to both all shareholders, but because shareholders can just share with anyone because it's now public information. we can now look at the internal finances of these companies and say, hey, because this is a profitable company, even though it's not issuing any dividends, we still expect that stock to go up by 5% as the same as the other company, the same exact financials, but they do issue a 5% dividend. So that's where we started to see in the 90s stock prices going up without the dividends, because we're now realizing that there's future revenues that will drive those stock price going up and the future profits, even though if you own the stock, you never actually got anything from it unless you actually sold it.
Yeah. I think two very good examples of that notion is probably like Berkshire and Amazon. So I just said, for example, you can value a stock by taking all the future dividends, discounting them appropriately, and just adding it up, and you get the stock price. Meaning, if you add up, for example, that was 50 cents that you get this year, next year, and so on, you add it all up and you discount it appropriately, you should get like $10 for that price of stock in the first example. But interestingly enough, for example, with Berkshire Hathaway, Warren Buffett's conglomerate, he never pays a single dividend. And he said, literally, I'm never going to pay you a single dividend. So why is it one of the best performing stocks of all time? Well, essentially what his job is to buy companies. And when companies earn more than they need to, he takes that money to buy more companies instead of sending it out to the investor. So basically, there's two things a company can do once it has extra money. It can take that money and give it back to the shareholders as dividends, or it can take that money and reinvest it in itself to make it grow even more quickly or make it bigger over time. And the interesting notion is when you pay out money, those dividends get taxed, right? When you show a profit, those profits get taxed from the company. However, if you grow the business such that any extra money goes right back into the business, A, the business doesn't show any profit, so it doesn't pay any taxes. And B, the investors don't have to pay any taxes either because there's no dividends either.
Yeah.
So now that's the Amazon model, frankly, where Amazon's job was to grow as much as possible such that any profit, in air quotes, that it made in a given year went straight back into fueling its expansion.
Yeah.
So you had stocks now like Amazon, like in the early 2000s, that were growing massively in terms of revenues, but were never paying out anything to investors, with the premise that we're just going to get so big that we're basically now the largest company on the planet, having never paid out any dividends to any significance. I don't know if that's changed recently or never.
I was using Apple example because they started making a dividend for the first time in the last decade or so. They went something like 40 years without a dividend.
And, frankly, a large part of that, in my mind, is a structural play on the U.S. tax system.
I agree. I totally agree with that. But I think that's not part of today's conversation.
Yeah, sure. I'll get off that soapbox.
Totally agree with that.
Yeah. But okay, so now you had tons of companies that were raising capital, they were printing shares, doing IPOs. But I think basically this kind of peaked in the late 90s, where actually you had more public companies then listed than you do today. So what you've seen since the 2000s is actually fewer IPOs, more buyouts, more private capital going into the market, and companies staying private longer. So you had a bit of an ebb and flow, and now the flow is essentially private companies have been able to raise capital without going to the public market so quickly. There have been a growth in private equity firms, which target high net worth individuals for investors and take that money and go straight to buying companies, right? Directly. You had angel investment firms. So now you had an alternative way for companies to raise capital rather than requiring an IPO.
Yeah.
Basically going straight to the people with the monies and or their intermediate private equity companies. So the de facto now isn't you need an IPO if you want to get big. In fact, some of the very largest companies have not even IPO'd yet. And we're seeing that for example, SpaceX with what is it, the XAI merger, are looking to be one of the largest companies straight into their IPO directly.
Yeah.
$1 trillion company straight from private. And you can do that now.
And so that's a great point that the reason companies raised money to grow and expand led to public markets, but we have gotten to a point where we don't need the public markets as much to fund these growth and expansion. Part of my question, trying to get back to like the very beginning of the premise, is what if they don't even need outside capital to grow and scale? And my first thought is like, well, okay, for some companies, especially on more of the software and the service side, if AI agents can replace an engineer or an individual in a kind of office work, knowledge work type of position, okay, that's easy for me to imagine. But if we're trying to build a rocket at SpaceX, we still need a factory, and if you're going to use, even like robots are building the rocket, we still need to like buy the robots or like figure out the technology. We still need materials that go into that. So I do think that there is still some capital raise for physical products, but less so for like that intellectual property side. And so,
yeah.
But like I'm trying to imagine, like, again, could you build a investment firm without hiring employees?
Yeah, so I think there's a few themes to consider. I think first, let's just put a scope on this. The size of the public markets today is around like 130 trillion globally, something like that. The private markets is still far, far smaller, like 20 trillion, like 80% smaller. So there's still a long way to go before this transition happens. But like I said, you can imagine why we've seen the trend of private markets increasing as a percentage of the overall markets, because there have become vehicles to target the high net worth individuals directly. For example, we already know that over the past 4 decades, wealth has been concentrating at the top.
Yeah.
So the less evenly distributed wealth is, well, the more efficient it is to go straight to the source, right? So public markets make a lot of sense when that middle class is growing and expanding. You want a way for them to participate. But if the middle class is shrinking and all of the wealth is accumulating at the top, well, that's likely where the financial products are going to accumulate around, right?
Yeah.
The ability for them to participate. So, the other theme, Aaron, that you alluded to is, things are also different in that you can become, there's been this theme that's been mentioned recently where we'll probably see the first $1 billion AI company that gets created with just one human, at the reins. Basically no capital investment whatsoever besides AI compute, right? It's all virtual, but you have $1 billion valuation. We may even have things that are close to that at this point. So at that point, you don't need to go out and build anything and raise money for anything, right? You just need a robot to build on itself. So that might be one trend that could lead to a difference. But I think the bigger trend to also think about, as I mentioned, is that consolidation of wealth, where what's the point of a public market if 99% of the wealth is consolidated in the top, 100 people? That does sound like a hyperbole, but I was thinking about this before this conversation a little more acutely. What I did is just a thought experiment with AI. I said, All right, so Musk has a few hundred billion. What if he takes 100 billion of that and just invests it in the public markets, buying up whatever and compounding at 7% per year?
Yeah.
How long until he owns half of the entire public market? And it was something where you would think, oh, that might take 1,000 years, but no, it's like 100 or so years, something like that. Meaning, if you have enough wealth with our current system and you don't tax it appropriately, if you're able to have exponential growth on that wealth by just investing and getting that market return, you end up owning a larger piece of that pie every year to the point where you basically become the pie.
So again, I don't want to go down the wealth inequality path, but today, again, but I like the perspective that you had. It's like I tend to kind of trust capitalism to innovate, fill needs. Like if there's a gap in some random thing that someone can profit by filling that gap, and they make money and society ends up being better off. Like that, like rough description of capitalism. And I did think about that, like that billion-dollar company owned by one person. Like it only had one employee. I thought that was what I thought when I asked the question. I didn't think of it from the perspective of if there's a decent middle class, the incentive for the financial institutions to make money is to continue like the public markets to access that money. Like they make money when they get people investing, and if the money is there in the middle class to be invested, they'll probably still figure out how to keep the public markets alive so that, again, the financial institutions can make money. And so again, thinking about like the incentives, like even for that one person who has $1 billion company valuation, because again, we're like that from like a discounted cash flow model, like they're generating what's 5%? Is that 50 million? Yeah. 50 million a year in revenue. Like, would that person want to try to cash out on their 50? Like, they can still keep control, but there could be a reason where they want $500 million and revenue of 25 million per year, or like they might be able to like make more money from cashing out a little bit to be able to deploy elsewhere, kind of thing. If they want to probably just diversify. It makes sense. Don't put your $1 billion all in one asset. That could be a regulatory risk, could be that you no longer get to use AI. Like it makes sense for them to want to cash out, even if they don't need to. They don't necessarily need the capital raised to fund things, but they might want to find a way to sell off portions of the business where they can they can take advantage of that future revenue. And like again, it's a $1 billion company doesn't mean they have $1 billion sitting in cash. It's the discounted cash flows of future revenue. So maybe they want more that they can diversify across elsewhere. So I like that. I had not thought about like the incentives of the financial system could still exist to keep publicly traded companies as long as there's enough what's the opposite of concentration, like disbursement of wealth across society, that a financial system is still in place to keep companies publicly traded.
Yeah. Well, okay. So I think you've come into basically where I land in terms of the big question of this conversation. Are public markets over? I don't think so for two big reasons, let's say. One is what you alluded to. It's that diversification notion.
Yeah.
Because even if you're wealthy, at a certain point, you just don't want to have all your wealth in one basket.
Mhm.
It just doesn't make sense. You've already won the race. Why risk something small toppling the empire? And the way I see it, I think giving John Jack some credit here. I think the index fund is probably one of the greatest inventions of mankind, frankly, because what you can do now is you can buy. Here's an example. There's ACWI, All World Country Index, right? This is
All
basically
Country World Index, ACWI.
ACW. Excuse my dyslexia. So the All Country World Index is basically an index of all publicly traded companies on the planet.
Mhm.
And you can buy that from the large institutions like Vanguard, the ticker is VT, for example, where literally you make one purchase, $1,000, and now you have an ownership interest in over 20,000 companies around the planet.
Mhm.
And the overhead on that is like pennies to the dollar in terms of fees. What is it, like 8 basis points or something?
I'm surprised it's not even lower.
It might even be lower, but it's amazing what we've been able to pull off, right? As a civilization, if you think about it, you can literally have an ownership stake in every single publicly traded company on the entire planet by putting $1,000 to work, and you can watch that grow, right? And it all somehow works, right? Across all these different countries, all these different currencies, all these different jurisdictions, and you can get it for a few mouse clicks of effort. So, a few things. I'd say even the wealthy would want something like this, want that diversification aspect once you pass a certain tipping point of wealth. You don't want to be that concentrated if you've already won the race. And you can get maximum diversification. And what you're basically saying at that point is, okay, the things that can topple me are either Earth does better, in which case this index will do better,
Mhm.
or Earth does not do better. But if Earth does not do better, we are in a lot of trouble, right? Because that means, what are the chances that the one particular thing that you have happens to be the one thing that does better, right?
Yeah.
In that scenario. So I think, the broad diversification publicly traded index is something that even the wealthy should engineer towards. But the other thing to think about, like, and maybe it's too late for this conversation to dig so much into it, but if wealth really does accumulate to the point where nobody has the ability to invest in this publicly traded index and then that goes away, I don't think that's good for the rich either. Right? So,
yeah.
like, literally just having all the money and nobody else having anything, leading to some sort of feudal state. I don't know. It just doesn't seem to make sense for even the rich.
So kind of heading towards wrapping up. Like I honestly don't expect the conversation to go this way. I at the beginning I thought like, man, Trishul's spending way too much time on like history. Like this is supposed to be an AI conversation. But it makes a lot of sense that like the publicly traded companies evolved from a multi-century process of getting the wealth away from just kings to everyone. It took centuries of that disbursement of wealth, and it was incremental progress at each individual point to get to the point where like publicly traded companies made so much sense in the economy and the financial system. And it's not AI that's going to kill public companies as long as there's still an incentive for, like you said, the diversification and ability for owners to want to own other things and to kind of be able to cash out on the company that they build. That is likely to be the driver of the success of public companies, not AI, meaning all the companies now are owned by one person.
Mhm.
Okay. Oh man, I good job, Trishul. Good job.
We got it done in less than an hour. So
Yeah. I am convinced. You got me. You had the right arguments. You laid the groundwork. I am proud of you today, Trishul. That was a good one.
I get a sticker or Taco Bell.
You get a heart.
Sure. Good stuff, Aaron.
Okay, so again, we're not going to talk about taxes today, but I've tried drifting away from like political conversations, as I say, like, but I do see why you kind of keep coming back to taxes and wealth inequality and other political aspects of society and how that impacts finances. Okay, we'll have another one of those conversations in the future.
I'm sure we will. Well, good stuff, Aaron. Thanks for indulging me on this conversation. But it was a good one. I enjoyed it, and thanks everybody for listening and watching.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.